Most high earners are betting against themselves. You've been told for years to max out your 401k, lower your taxable income today, pay the piper later. The logic seems sound. Save money now while you're earning high and pay taxes later when you're retired and earning low. But that advice relies on a critical assumption that is about to break. It assumes that tax rates in the future will be lower than they are today. And if you look at the legislative calendar, specifically January 1st, 2026, that assumption is mathematically dangerous. We are currently living through a tax sale. The Tax Cuts and Jobs Act created historically low income tax brackets, but that law has a sunset clause. It expires at the end of 2025. Unless Congress acts, tax rates will revert to their previous, higher levels automatically. If you are blindly dumping capital into a traditional 401k right now, you aren't just saving for retirement. You are deferring your tax liability into a future where the bill is guaranteed to be higher. You are skipping a 24% tax today to potentially pay 28% or 33% on that same money later. In the corporate world, buying high and selling low is how you go bankrupt. In personal finance, we call it standard advice. The silent partner in your 401k is the IRS. The problem is, they get to decide their percentage of ownership after you've done all the work. We need to rethink the psychology of tax deferral. This isn't just about choosing between a 401k and a Roth IRA. It is about understanding that tax diversification is just as critical as asset diversification. To understand why this trap is so effective, we have to look at our own psychology. We have a collective addiction to the immediate tax deduction. When you contribute to a traditional 401k, you get an instant dopamine hit. You see your taxable income drop on paper. Your CPA gives you a thumbs up. It feels like you beat the system for the current year. But this is short-term thinking masquerading as a long-term strategy. It is the critical difference between tax preparation, which focuses on minimizing the check you write this April, and tax planning, which focuses on maximizing the wealth you keep over your lifetime. Think of it through the lens of a farmer. If the IRS came to you and said, you can pay tax on the small bag of seeds you buy in the spring, or you can pay tax on the entire harvest you sell in the fall, which would you choose? Any rational person would pay tax on the seed. The seed is cheap, the cost is known, the harvest, if you're a good investor, is massive. Yet, with the traditional 401k, you are voluntarily choosing to pay tax on the harvest. You are compounding your money for decades, growing it to millions, only to let the government step in at the very end and take their cut of the entire accumulated amount, principal and growth combined. But here's where it gets interesting. The government understands this math better than you do. They designed the system. When the tax code encourages deferral, the government is essentially saying, please, keep your tax money today. Go invest it. Take all the risk. Grow it as large as possible. We will wait. They are willing to wait because they know that 30% of a watermelon is worth a lot more than 30% of a grape. So the danger of 2026 isn't just that the percentage they take is increasing. It's that you are building a massive tax bomb that will explode right when you can least afford to defuse it. We need to dismantle the single biggest lie in retirement planning. A myth that has been repeated so often it is accepted as gospel by intelligent people who should know better. The lie is this: you should defer taxes now because you will be in a lower tax bracket when you retire. On the surface, it sounds logical. You are in your peak earning years today. When you retire, you stop working, your salary goes to zero, and therefore your tax rate should drop. That is the linear, optimistic view of the world. But you aren't planning for an average linear life. You are planning for wealth. And for the wealthy, that logic falls apart completely. Think about what you are actually saying when you bet on having a lower tax rate in retirement. You are betting that you will be living on significantly less money than you are today. You are betting that your lifestyle will contract, that your spending will shrink, and that your abundance will decrease. Is that really the goal? Are you working this hard just so you can live a smaller life in your golden years? The goal is to maintain or even expand your lifestyle. You want to travel, support your family, maybe buy that second home. If you are successful in building a multi-million-dollar portfolio, your income in retirement shouldn't be lower. It should be equal to, or perhaps even higher than, what you earn today. And here is the trap. In retirement, you lose the tax shields that protect you now. Right now, you likely have mortgage interest deductions. You might have dependents. You are contributing to 401ks, which lowers your taxable income. Fast forward to retirement. The house is paid off. There goes the mortgage deduction. The kids are grown. There go the dependent credits. You are no longer contributing to retirement accounts. You are withdrawing from them. So you have a situation where you have the same level of income to support your lifestyle, but fewer deductions to offset it. Mathematically, that pushes your effective tax rate up, not down. Then we have to layer on the legislative reality. The Tax Cuts and Jobs Act expires in 2026. Let's look at the numbers. Right now, if you are a married couple filing jointly with a taxable income between roughly $190,000 and $364,000, you are in the 24% tax bracket. That is historically very low. When the clock strikes midnight on December 31st, 2025, that 24% bracket doesn't just inch up, it reverts to pre-2018 levels. We are likely looking at a jump to 28% or even 33% for similar inflation-adjusted income levels. If you have $2 million in a traditional 401k and the tax rate jumps 4%, you didn't just lose a little bit of income, you lost $80,000 of purchasing power overnight. That is the cost of a luxury car or 2 years of college tuition vanished because Congress failed to renew a bill. But the problem gets worse. The traditional 401k doesn't just expose you to risk, it removes your autonomy. When you hold money in a brokerage account or a Roth IRA, you control the spigot. You decide when to sell, how much to take, and what tax consequences you are willing to accept. With a traditional 401k, the government controls the spigot. At age 73, you are hit with required minimum distributions or RMDs. The IRS essentially says, "We have waited long enough for our cut. Pay us." They force you to withdraw a calculated percentage of your portfolio every single year, whether you need the money or not. It doesn't matter if the market is down 20% and you want to let the account recover. You have to sell. It doesn't matter if you have plenty of cash in the bank. You have to withdraw. This forced income sits on top of your Social Security, on top of your pension, and on top of your dividends. It fills up the lower tax buckets instantly and pushes the rest of your income into those higher reverted tax brackets. It creates a tax floor that you cannot go below. You lose the ability to manage your own tax bracket. And there is a darker side to this that financial advisors rarely mention. It's what I call the widow's penalty. We plan as couples, but we rarely die at the exact same time. Statistically, one spouse will outlive the other, often by a decade or more. When that happens, the surviving spouse creates a tax disaster simply by waking up the next morning. They go from married filing jointly to single. The tax brackets for a single filer are roughly half the size of a married couple's. An income of $200,000 might be comfortable in the 24% bracket for a couple. But for a single survivor, that same $200,000 pushes them deep into the 32% or 35% bracket. So the surviving spouse is left with the same household expenses, property taxes don't go down when your spouse dies, heating bills don't get cut in half, but their tax bill skyrockets. And where is the bulk of their wealth sitting? In that traditional 401k, which is fully taxable upon withdrawal. By deferring taxes today, you aren't just betting on tax rates. You are betting that you won't be successful enough to have high income later. You are betting that the government won't raise rates to cover the national debt. And you are betting that you will never face a life event that changes your filing status. That is a lot of variance to introduce into a plan that is supposed to be safe. We need to reframe what a traditional 401k actually is. It is not a savings account, it is a debt. When you put $23,000 into a 401k, you are taking a loan from the US government. They are lending you the tax money you would have paid today. Let's say $5,000. They let you invest that $5,000. But unlike a mortgage or a car loan, where the interest rate is fixed and the terms are clear, this loan has a floating rate that is determined by a group of politicians 20 years from now who haven't even been elected yet. The If you went to a bank and they offered you a mortgage where they could retroactively change the interest rate to whatever they wanted in year 30, would you sign that paper? Of course not. It would be financial suicide. Yet, that is exactly the contract we sign every time we choose the tax deduction over the tax exemption. We are prioritizing a known benefit today in exchange for an unknown, unlimited liability tomorrow. This brings us to the pivotal question. If the traditional 401k is a trap for high achievers and the tax landscape is shifting under our feet in 2026, what is the alternative? The answer lies in a strategy that feels painful in the short term but mathematically superior in the long term. It requires us to stop asking, how do I pay less tax this year? And start asking, how do I pay zero tax forever? We need to move from a philosophy of tax deferral to a philosophy of tax elimination. In the financial world, this is often labeled simply as Option B, the Roth ecosystem. But calling it just another account type trivializes its power. When you utilize a Roth strategy effectively, you aren't just saving money, you are severing your partnership with the IRS. With a traditional 401k, you own the account, but the government owns a lien on it. With a Roth, you own the asset free and clear. You have paid the toll, you have crossed the bridge. The government has no claim on your harvest, no matter how large it grows or how high tax rates climb in the future. Now, I know the objection that is forming in your mind right now. I hear it from engineers and CPAs constantly. They say, but the math is the same. If my tax rate today is the same as my tax rate in retirement, it doesn't matter if I pay the tax now or later. The net result is identical. Mathematically, in a vacuum, that is true. It is the commutative property of multiplication. $100 taxed at 25% and then grown by 10% yields the same result as $100 grown by 10% and then taxed at 25%. But we do not live in a vacuum. We live in a legislative reality where variables change. That math is the same argument relies on a single fragile assumption that your tax rate will remain flat. As we've just established, that is a bet against history and a bet against the current law. If tax rates rise, which the 2026 Sunset Clause guarantees they will for many high earners, the math breaks. The equivalence disappears. Think of it this way. Imagine you are walking into a store and everything is 20% off. That is the Tax Cuts and Jobs Act environment we are in right now. You know for a fact that on January 1st, 2026, the sale ends and prices go up. Would you say, I think I'll wait to buy these goods until 2027 when they are full price again, just so I can keep my cash in my pocket for another year? No. You would buy as much as you possibly could while the sale is active. That is exactly what a Roth contribution or conversion is right now. It is buying out the government's share of your wealth at a historically low price. You are locking in a known cost, your current tax rate, to eliminate an unknown, uncapped liability in the future. But there is a psychological hurdle here. To execute this strategy, you have to write a check. You have to voluntarily increase your tax bill this year. Human brains are wired for loss aversion. We feel the pain of losing $100 today twice as intensely as the pleasure of gaining $100 tomorrow. This is why the traditional 401k is so seductive. It relieves immediate pain. But wealthy people override this instinct. They understand that wealth isn't measured by what you make this year. It's measured by what you keep over a lifetime. When you pay the tax on the seed today, you are purchasing certainty. You are buying the freedom to never worry about what Congress does next. If the top marginal tax rate goes to 50% in 2030 to fund a deficit, you don't care, your money is Roth. If they introduce a new surcharge for high net worth retirees, you don't care, your income doesn't show up on the tax return. And this leads to the most critical advantage of option B, autonomy. We talked earlier about RMDs, required minimum distributions, in traditional accounts, the government forcing you to sell. Roth IRAs do not have RMDs during the owner's lifetime. This is a massive shift in power. Because you have already paid the tax, the IRS doesn't care when or if you withdraw the money. You can let that account compound untouched until you are 85, 95, or 100 years old. You can use it as a true legacy vehicle, passing it down to your heirs completely tax-free. Consider the impact of the Secure Act 2.0 on your children. If you leave them a traditional 401k, the government now forces them to drain that entire account within 10 years. If they are in their peak earning years when they inherit it, that inheritance gets stacked on top of their salary, potentially pushing them into the highest tax bracket possible. You effectively leave them a tax bomb. If you leave them a Roth IRA, they still have to empty it in 10 years, but every single dollar they withdraw is tax-free. It doesn't affect their tax bracket. It doesn't increase their Medicare premiums. It is pure, unadulterated wealth. So, when we weigh option A against option B, the scales are not balanced. Option A, the traditional 401k, offers a temporary dopamine hit of a tax break today in exchange for legislative risk, forced withdrawals, and a potential tax disaster for your heirs. Option B, the Roth strategy, demands a payment today. It requires discipline, but in exchange, it offers mathematical immunity from rising rates, total control over your cash flow, and the most efficient transfer of wealth possible. The question isn't, do I want to pay taxes? You are going to pay taxes either way. The question is, do I want to pay taxes at a rate I know and can control, or do I want to pay taxes at a rate determined by a desperate government 20 years from now? For the high agency investor, the choice is obvious. You buy the seed, you protect the harvest. But realizing this is only the first step. The execution is where most high earners get stuck. You might be thinking, I make too much money to contribute to a Roth IRA, or I already have a massive traditional 401k. Is it too late for me? This is where the nuance of tax diversification turns into tactical execution. There are backdoors, loopholes, and specific conversion strategies designed exactly for people in your income bracket. But you have to execute them in the right order, or you trigger penalties that wipe out the benefits. The difference between a tax disaster and tax mastery often comes down to a single boring variable: velocity. Most people hear Roth conversion and think it's a binary switch. They think they need to move their entire $1 million portfolio from column A to column B tomorrow. If you do that, you aren't fixing the problem, you are compounding it. You would be taking income spread over 30 years and compressing it into a single tax year, voluntarily pushing yourself into the highest tax bracket possible. That is financial suicide. The strategy is not a switch, it is a dial. And for the next 2 years, until that 2026 deadline, your job is to turn that dial with surgical precision. We call this bracket topping. Think of your current tax bracket as a bucket. If you are a married couple earning $250,000, you are sitting comfortably in the middle of the 24% bracket. The ceiling of that bracket is roughly $383,000. That means you have about $130,000 of space left before your rate jumps. Every year, you want to convert just enough of your traditional 401k to fill that bucket to the very brim, but not a drop over. You are essentially locking in the 24% rate on that specific slice of money, stripping away its future tax liability forever. You do this in 2024. You do it again in 2025. You systematically drain the swamp of your future tax liability while the sale prices are still active. But here is the specific nuance that separates the wealthy from the merely high income. It's the head-to-head battle of where the money comes from. When you convert that $100,000 slice, the IRS is going to send you a bill for $24,000. You have two choices on how to pay it. Choice A. You pay the tax out of the retirement account itself. You sell $124,000 of assets to convert $100,000. Choice B. You pay the tax out of your cash savings, your checking or brokerage account, and let the full $100,000 move into the Roth. Choice A is what most people do because it feels cash flow neutral. It doesn't hurt your bank account today. Choice B is what wealthy people do. Why? Because when you pay the tax with outside cash, you are effectively performing a magic trick. You are taking $24,000 of cash, which is usually a drag on returns, and instantly transforming it into tax-free investment capital. You are increasing the density of your retirement account. Think about the math. In choice A, you have $100,000 compounding tax-free. In choice B, you effectively have the growth of that extra $24,000 compounding tax-free as well, because you didn't have to sacrifice principal to pay the toll. Over 20 years, that decision alone can be worth hundreds of thousands of dollars. It feels painful to write a check to the IRS today when you don't have to. It feels like losing money, but you have to reframe the pain. You aren't losing money. You are buying an asset. You are buying exemption. And for those of you sitting there thinking, this sounds great, but I make $500,000 a year, I'm barred from these accounts. You are operating on old data. There is a mechanism specifically designed for high earners that bypasses the income limits entirely. It's not a loophole, it's a codified process known as the backdoor Roth. It involves contributing post-tax money to a traditional IRA, which anyone can do, regardless of income, and then immediately converting it to a Roth before any gains accrue. If your employer offers a mega backdoor provision, you can shove up to $69,000 per year into this tax-free sanctuary. Most high earners ignore this because it requires extra paperwork. They leave it on the table because it's complicated. Meanwhile, their peers are funneling nearly $70,000 a year completely off the IRS's radar, compounding tax-free, accessible tax-free, and inheritable tax-free. The barrier isn't the law. The barrier is your willingness to navigate the friction. So, as we stare down the barrel of 2026, the question isn't should I convert? The question is, how much can I afford to buy out of the system this year? Because every dollar you leave in the traditional bucket is a dollar you are gambling with. You are betting that Congress will be fiscally responsible. You are betting that tax rates will go down. You are betting that you won't succeed. I prefer to bet on things I can control. Ultimately, the choice between the traditional 401k and the Roth isn't really a math problem, it is a question of sovereignty. When you choose the traditional path, you are effectively signing a partnership agreement with the IRS where they hold the majority of the voting rights. You are betting that the rules won't change just as you reach the finish line. Given the national debt and the looming expiration of the Tax Cuts and Jobs Act in 2026, that is a bet I am not willing to take. The safe option has mathematically become the risky one. The Roth strategy is the inverse. It is a declaration of independence. Yes, it hurts to write that check today. It requires the discipline to accept less cash flow right now to secure a massive advantage later. But that pain is simply the price of certainty. When you choose the Roth, you are buying your way out of the system. You are ensuring that every dollar of growth, every dividend, and every compounded gain belongs to you and your family, not the Treasury. You are removing the government's ability to change the terms of your retirement. So the verdict is this: stop optimizing for April 15th. Stop trying to beat the IRS this year by kicking the can down the road. That road is running out of pavement. Real wealth is not just about having a large balance on a screen, it is about the accessibility of that money. $1 million that is 100% yours is worth significantly more than $1 million that carries an unknown, floating mortgage held by Congress. Pay the tax on the seed so you can keep the harvest. Secure your autonomy before the laws change, because the only thing better than being wealthy is being free. If this shift in perspective was valuable to you, subscribe. We don't do hype here, just clarity. I'll see you in the next one.